Hello guys and welcome back to a new video. Today's lesson is gonna be a short one and I want to address a problem that a lot of traders have. I see it all the time. A lot of traders will come to me in my Twitter account, they send me their trades, right? And they pretty much have the same problem. So instead of just replying to them one by one, I wanted to make this video because I see this as a universal problem. No matter what system you use, whether it is ICT, DTFX, Elliott waves, I see this all the time, right? And the major problem is that they don't even realize this mistake. They can't even identify it, so there is no way that they're gonna fix it in the near future. This mistake is both technical and psychological at the same time. Alright, so without any further mysterious introductions, let's dive into the chart and talk about it, right? So, what most traders do, and this is the standard process, whatever system you are using, they start with the higher time frame, right? So, they open the chart on the higher time frame. It doesn't matter what time frame you are using. So, for me, the higher time frame is the 15 or the 1 hour. For you, it can be the weekly or the daily, right? So it doesn't matter. Anyway, and let's say we are in this portion right here, this one right here, okay? So they open the chart. This is their higher time frame, and let's say that the 1 minute is their execution time frame. So they're gonna start with the 15-minute, and they're gonna start applying their concepts, whatever concepts you are using, to predict the next direction of the higher time frame. So let's say we are in this point right here. Now, you did your analysis, and now you are trying to predict whether the market is gonna go up from here, or it's gonna travel to the downside, right? Now, there is certain times where you can't have a clear idea whether on the higher time frame whether the market is gonna travel up or down. This is a good example right here when we have like a small range, especially on the higher time frame, and you don't know if the market is gonna trade to the upside or the downside. So not, for example, like this when we have a clear uptrend, or even this, or this is a clear downtrend. You see the difference, right? But here you don't have a clear time frame. So the next step is they're gonna go to the lower time frame, right? And here's where the mistake begins. Okay, so they're gonna open the lower time frame. Keep in mind, they have no idea where the higher time frame is going. So they open the lower time frame, and now they are watching the candles printing. And now they see a potential, maybe a shorting opportunity. So they see their entry pattern on the lower time frame, and it is giving them a short signal. Let's say, for example, a shorting from here maybe, right? This is their execution time frame, and they see their entry pattern or their entry criteria giving them a short signal. So the next thing they do is that they come back to the higher time frame and they try to find something that support that idea of going short. And this right here is a major problem when doing technical analysis. The problem here is that 9 out of 10 times you will find something logical at that time, something logical that support your idea on the lower time frame to go short. Although when you open the higher time frame for the first time, you didn't see anything clear. Why? Because you were objective, right? You don't have any idea of going long or short. You are simply looking at the market and trying to get a feedback from the price whether it wants to go up or down. But when you went to the lower time frame and you see that entry pattern giving you a short signal, now everything changes. Now you are not being objective. When you come back to the higher time frame, right, you will see everything suddenly is supporting that lower time frame short, and now you come back to the lower time frame thinking you are aligned with the higher time frame. You take that short, right? You take that short, and then most of the times you will get stopped out. Most of the times, sometimes you will get the winner, but in the long run over a series of trade, you will take more losses than winners, especially if you have like a 2-hour trade, because now for example, in a 1-hour situation, it's like 50-50. But when you take like a 2-hour or 3-hour trade, you will not be profitable on the long run, even if you are gambling, even if you are taking like random trades. So this is your mind tricking you. When you don't clearly see the higher time frame, you go to the lower time frame, you see a short signal, you come back to the higher time frame, and suddenly again everything makes sense. So that's not how you do technical analysis, and that's not how you build your idea. In order for you to build a valid trading idea, no matter what system you are using, you're going to the higher time frame, right? You are completely objective. You observe price and you are looking for signs whether the market wants to go up or down. Let's say, for example, you went to the higher time frame and you found out that the market is likely to travel up, right? It's likely to travel up next. Now, what you're going to do next is you're going to go to the lower time frame and you will see if the lower time frame is supporting the idea of going long. So can you see the difference right here? The lower time frame should be supporting the idea of going long, not the other way around, right? The lower time frame is confirming your idea to go long. So now you are on the lower time frame. You are waiting now for price to give you or to confirm to you that idea you get from the higher time frame. If price didn't give you that on the lower time frame, you move on, right? So that initial idea is just a potential move to the upside. You don't have a setup. You are not thinking about taking a trade because all you have is a general direction in mind. But when you go to the lower time frame and you see an entry pattern, so now this is the closest thing to actually getting money, getting profit from the trade, from the market, right? And you start calculating how much money you're going to lose, how much money you're going to make from this trade. So you go to the higher time frame and you are completely biased, you are completely illogical, although it looks logical. But when you close a chart, when you take a loss and you come back later on at the end of the day, right, and you review what you did in hindsight, you will find out that you took a trade against the higher time frame, or at least the higher time frame was not supporting your idea of going short on the lower time frame by any means. So what is the solution to that? By simply opening the higher time frame. If you don't have a general direction, if you don't know what to do next, and that is normal, right? This is not embarrassing or something. Don't involve your ego. If you don't understand it, come back after an hour. Maybe after an hour, price is doing this, right? You can see that we have a clear direction to the upside. As you can see, beautiful. Come back tomorrow. But don't try to go to the lower time frame and try to force a setup. So that's a piece of advice that I believe it will help you. So I wanted to make this video because I see a lot of traders doing this mistake, and also I did it in the past, right? It took me a very long time to identify it and to eventually fix it, right? So if you like this video, if you found it informative, make sure to leave a like, and if you have any further questions, DM me in my Twitter account or leave a comment down below. Now, happy trading and good luck.